Sub-Saharan Africa already had the highest rate of problem loans in the world when the pandemic hit, a trend likely to continue in the near term.
So how do we ensure that these bad loans don't hold back the post-pandemic recovery?
My name is Tarak Jardak.
And I'm Jehann Jack. We're part of a team of IMF economists who studied what these problem loans could mean for the recovery and the future of the region.
Problem loans, also called non-performing loans or NPLs, are loans that are either overdue or with some uncertainty involved in their repayments. NPLs are considered an acceptable cost of doing business, but beyond a certain level, they can hold back credit and growth. With the highest level of NPLs and the lowest level of financial development, Sub-Saharan Africa perfectly illustrates these links.
And now, the COVID-19 crisis has brought on the continent's worst ever recession and put further strain on the ability of households, businesses, and even governments to repay banks.
All of these factors are likely to make the NPL problem worse. Our goal is to offer solutions on how to manage and resolve NPLs, something easier said than done. But it's important to act now, so that the post-pandemic recovery isn't undermined by an insufficient supply of credit.
To fix the problem, we need to understand what's responsible for these bad loans. Looking at past NPL surges in Sub-Saharan Africa, we find that they've resulted from four main factors: adverse macrofinancial shocks, macroeconomic policies, banking sector problems, and other structural issues. For example, droughts and conflicts, as well as decreasing commodity prices, tend to deteriorate credit quality. Increases in interest rates and public sector unpaid bills also cause the rise in NPLs. Furthermore, the impact of these shocks has been more acute in countries with either inadequate banking supervision or weak corporate governance.
The pandemic has worsened most of these conditions, while adding new complications. Regional growth has plummeted, with many countries experiencing recessions. Most businesses in the region require face-to-face interaction, so the majority of jobs can't realistically be done remotely. Activity in service sectors like tourism has yet to return to pre-pandemic levels, and with the delays in vaccination rollouts, maybe won't for years to come. This reduced activity creates repayment difficulties and increased debt. This in turn may lead to a surge in NPLs. At the same time, the pandemic has driven up government support to firms and households at a time when public revenues are falling. All of this is creating a situation where both public debt and loan guarantees have risen significantly. This not only limits government's capacity to further support the private sector, but may also increase lending rates.
That said, so far, we've not seen the full impact of the crisis on NPLs. Why is that? Well, first, some governments have put a moratorium on loan repayments, basically giving people the possibility to defer payment without penalty. The moratorium means that some of these unpaid loans aren't technically classified as NPLs. Second, there have been loan guarantees and other liquidity support from governments. This, together with lower interest rates and favorable financial conditions globally, have moderated the immediate impact of the crisis. And once these measures expire and global interest rates start normalizing, we can expect to see NPLs increase further.
If nothing is done about this, capital will be tied up in debt, and banks won't be able to grant the much-needed fresh credit to support the recovery. This may ultimately make the crisis more persistent. However, we believe that this scenario doesn't have to define the future of the region, and we've proposed a three-pronged strategy that can address the problem of NPLs. In the short term, when possible, governments should continue targeted support for viable businesses and vulnerable households. They should also avoid delaying bill repayment to the private sector. Banks, for their part, should prioritize strategies to manage their customers' diminished capacity to repay. During this phase, It is essential for supervisory authorities to ensure NPLs are well recorded and provisioned for.
Once financial conditions return to some level of normalcy and exceptional relief measures are withdrawn, it will then become possible to assess the full impact of the crisis on NPLs. And then, the key priority is to encourage banks to move NPLs off the books by using measures such as selling these problem loans to asset management companies. In this context, supervisors can agree with banks on ambitious and measurable goals such as cash collection, loan restructuring, and outright asset sales. Moreover, shortening the court procedures for foreclosures to 1 or 2 years would greatly reduce the cost and increase incentives for banks to actively clean their balance sheets. Finally, in the longer term, policymakers can enact strategies to prevent future problem loans by enhancing credit information systems, strengthening banks' risk management frameworks, and building on the recent improvement in banking supervision.
We are likely to see the fallout from the pandemic for years to come in Sub-Saharan Africa and beyond. And the last thing we want is for banks to become unable or reluctant to finance the economy. Managing and resolving NPLs is going to be critical for the post-pandemic recovery in Sub-Saharan Africa. While numbers vary across countries, our study estimates that for each dollar of NPLs that banks write off, 50 cents of new credit is created.
This won't be an easy task, yet, by working together, banks and governments in the region can exit the cycle of bad credit and not just support a recovery, but create opportunity.